If you are interested in the fastest, cheapest, and easiest source of real passive income, then you should watch this video. Because today we're talking about dividends, which are actually the fastest, cheapest, and probably easiest way to get started making passive income today. For anyone who doesn't know what a dividend is, it's when a company that you own stock or shares in chooses to pay out profits back to you, the shareholder. This means that if you own $100 of a stock with a 5% dividend yield, they will pay you $5 a year for doing absolutely nothing. We'll talk through 3 reasons why optimized portfolio would tell you dividends suck, with my own commentary, including why I still love dividends despite the bad press, with a recommendation on how you can start your own dividend investing portfolio. The first negative that optimized portfolio talks about is that dividends result in a larger tax burden that limits total returns. This is true. Think of this. You buy $100 each in 2 different stocks. Relentless Growth, ticker symbol RG, and Relentless Dividend, ticker symbol RD. Which one will make you more money? Well, it depends, but let's pretend that the dividend yield is 0 for the growth stock and 10% for the dividend stock. We'll also assume that every dollar spent on additional marketing or additional research and development by this same Relentless company equals a proportional increase in the stock price. So if Relentless pays out all of its profits as Relentless Dividend, then you get a 10% dividend yield or $10 in cash per year. We'll assume the company grows 10% annually. But because RG is instead reinvesting their profits into the business instead of paying it out to you, this makes their annual growth 20%. That means at the end of 1 year, Relentless Growth is now worth $120. For Relentless Dividend, this gets a little more complicated. You gain 10% or $10 from growth in this case, but the other 10% dividend was also paid out. The catch is you're also going to pay taxes on that dividend. Now, the taxes you pay on a dividend can vary based on how much dividend income you have or the kind of dividend, but for easier math, we'll assume you make a lot of money and your capital gains tax rate is 20%. Assuming you use a dividend reinvestment plan with your brokerage, this means your new account value is $118. If we extrapolate this out to 5, 10, and 20 years, this is what we end up with, assuming growth holds steady. So, with a starting value of $100, Relentless Growth after 5 years is worth $249. Relentless Dividend after 5 years is worth $229. 10 years, RG is worth $620. RD is worth $524. And after 20 years, Relentless Growth is worth $3,834, whereas Relentless Dividend is worth $2,740. And remember, that's assuming that all of the dividends are reinvested through your brokerage. Please realize these example returns we're using are really high. It just makes seeing the math a lot easier. Basically, taxes suck, and assuming that you're choosing between a company that is paying a dividend versus a company that can use the extra cash to grow, the growth company will, in fact, make you more money, assuming all other things are equal. And this becomes more pronounced the longer you hold the investment or the more money that you put in. So, optimized portfolio is 100% right on this one. The tax burden slows the compounding return of the investment. Now, when you sell off shares in either case, you will pay taxes on your realized gains, but that should be the lower capital gains tax rate if you held the investment for over a year, which you should generally aim to do with most investments. The reason this effect works the way that it does is you're getting to temporarily have that extra 2% compound for you every year instead of paying that money to the government. So by the time you sell off and owe the government, those additional gains have almost definitely made up for the additional taxes that they cost. And pretending that growth and dividends equate to each other is a reasonable assessment. That's because we can see in the market that most companies that are growing are focused on reinvesting their cash, like Tesla and Amazon. And companies with substantial dividends tend to be very old companies that don't really have a lot more market share to grab, like Coca-Cola, AT&T, or Exxon. That doesn't mean that 1% of annual growth perfectly translates to 1% of dividends that could have been paid. Maybe reducing your dividend by 0.5% would allow for 2% extra growth. Or you would need to cut your dividend by 2% to get just 1% of additional annual growth. Optimized portfolio states that markets tend to be very efficient, but they are only approximately efficient and in the long run efficient. One of the greatest ways to make money in any investment is to take advantage of market inefficiencies, which might be an undervalued company in stocks or a fixer-upper in real estate. The second negative optimized portfolio brings up is dividend chasing results in decreased diversification. Optimized portfolio says that chasing dividends means you have to ignore 60% of the total stock market. I'd say wow, but I'm not really surprised. Certain sectors are just more likely to pay high dividends, like mortgage REITs and utilities, but tech companies basically don't pay dividends at all. That does mean you are less diversified, and so while your maximum possible gains are higher, your maximum possible losses are also higher, assuming all other things remain equal, which might not be because, for example, utilities tend to be very stable compared to a lot of other industries. I also think that specialization can be just as powerful as diversification. I am, in fact, decently well diversified in my stocks right now, partly by coincidence of the stocks and funds that I pick, but also because early on I started with dividend stocks and broad ETFs. However, both Phil Town and Warren Buffett would recommend a smaller investor like me and you specialize and focus on purchasing undervalued companies and industries that we have insider understanding of. The odds of you knowing how both artificial intelligence and commercial real estate work equally well are really low. So, the advice from billionaire investors would actually be against diversification if your goal is high gains. That said, most people don't trust their own choices and are scared to lose money. So, I understand why someone would value diversification, and if your main goal is to get some dividend yield, you will cut out a large chunk of the market for yourself, and if you want a high dividend yield, then you will almost inevitably hyper-focus on a few industries. For example, I do have about 20% of all my stocks in what is usually called the finance sector, so banks and financial services or real estate investment trusts. This does mean if lending as a concept goes to hell, there's a gigantic series of evictions this year because of the Rona recession or anything like that, that 20% of my portfolio will absolutely tank. But I'm okay with that because I've gotten over a 20% return every year that I've invested, and when stocks drop, I just buy more because they're on sale. So, while optimized portfolio is right to say that chasing dividend yield makes your portfolio undiverse, this isn't necessarily a bad thing, according to several billionaire investors. Negative number 3. Dividends only grant a psychological benefit that is not guaranteed. Excellent points on both fronts, but it is two parts, so we're going to talk about the second part first and the first part second. Starting with the latter part, that dividends are not guaranteed. That's just true. The company has no legal obligation whatsoever to give you a dividend. So, dividends are more like a promise than a contractual agreement. During the COVID recession, a lot of companies either reduced or halted their dividend because they needed to keep the cash on hand to survive. I think that's just fine, and it happens a really small portion of the time. The former part of this argument is that dividends are only a psychological benefit. If a general is able to invigorate the troops with morale, that's only a psychological benefit, but then they end up fighting harder and being less likely to run away and more likely to risk their lives to save each other, but it's just a psychological benefit. Psychological benefits are real benefits. This makes dividends especially important for people who are just wading into stock investing. I've barely been doing it for 3 years, and most of the first year was just a retirement account. With the retirement account, I was able to not think about it because I knew my employer was matching contributions, meaning I had an expected return of 100% regardless. So I almost never checked that account. But when I started investing additional money into brokerage accounts, like the links down below in the description, I wasn't sure if I had learned academically how to pick stocks or funds decently yet. But I also knew that you shouldn't invest money you can't afford to lose and that you learn best by doing. So I started off with a very broad index fund and dividend stocks, which are still a very large chunk of my portfolio because no matter what, that $100 that I invested will almost definitely get me something, whether it goes up or down. That $100 is going to buy me a $5 a year income for more or less my entire life. Lo and behold, I've gotten over a 20% return each year using this approach, and I only came below 25% this year because I've contributed to buy stocks over time. So when you buy a stock for $10 in March and then you buy it for $20 in August, then your average price is 15, which means your return average is lower because I keep buying. That considered, this seems to be working, and I think this high of an almost certain benefit is especially helpful for new investors. Now, if you're not so new or you're doing something very different like real estate or day trading, yeah, don't think about dividends. And if you want stocks to be your main investment vehicle, then history does show that purchasing undervalued individual stocks tends to work out best, like what Warren Buffett and Bill Town recommend. One of my friends picked stocks that way, and she's managed to get like a 60 or 70% annual return. Once I'm done stacking my emergency funds to buy more real estate, I think I'm going to start doing that her way. So, what do I recommend you do? First, don't invest money you can't afford to lose. Second, if you want to maximize your gains and don't mind losing money part of the time, I check out Philtown's website for training on how to value stocks and buy them at a discount. I've been doing more so macro analysis based on whole economies or sectors for growth potential, and that's been doing well. But Phil's been doing it longer than I've been alive, and I don't have a precise system for macro analysis worked out yet. Third, I would recommend you download Robinhood. They aren't perfect. They have bugs a lot. But they have the most user-friendly interface, so it's easy for you to get started. Then try buying a dividend-paying broad index fund like SCHD, SPHD, or OUSA. From there, keep consuming good educational content like this video or the articles at Optimize Portfolio to see what strategies you want to hop into. The high of the dividends from these funds will give you an incentive to keep going. And since they are broad funds, while the returns won't be stellar, probably, they will generally go up in the long run, so you don't have much of a risk of losing money. That said, you are an adult, and you are responsible for your own decisions. And if you buy a stock or a fund and the market crashes next month, you're going to lose money, at least in the short term. But a savings account will never make you rich, and your wealth is what you and your loved ones deserve. You only have one life to live. Grow it relentlessly.